Hey guys, this is George David with George David Investing, and in this video today, we're going to be talking about the unemployment rate and how, surprisingly, we came up with a negative report unexpectedly for April of 2021. So let's break down exactly what that report entailed. So currently, we only added a little bit over 230,000 jobs in April of 2021, but in the aggregate, unemployment rate went actually from 6.0% up to 6.1%. So this one's really interesting. Is this something that you should be concerned about? Is there any plays that we could do in the short term? How is this affecting long-term ramifications? So let's break that down all into different elements. Is there a play to be made in the short term? The answer is yes. Some of the sectors that are more price sensitive, like tech, they're going to be a little bit more reactive to this. You have a potential 2 to 3% play in some of those sectors if you've done your due diligence there. But at the same time, is this something to be concerned about? The answer is no. I mean, the full economy, when it's fully open and what the Fed is looking for any kind of interest rates outside of exponentially higher inflation, which we'll know pretty soon, and it's going to come in a little bit higher than expected as well, especially on the holistic side when you're including food and energy, is that, yeah, there's a little bit of a systemic issue right now where we're trying to get the economy better and we're hovering at 6%. Full employment comes at 3.5. Anything below 4% is fantastic. You pretty much made a full recovery there. The real number there is 3.5%. So the fact that we're still at 6% means that there is systemic spending issues that need to be bridged. So the fact that we haven't gone below that, a little bit of a yellow flag. Now, in terms of economic recovery, the one time I really would get concerned is if unemployment rates go above 0.6% of floor. Now, historically back testing this basically is the tipping point at 100% confidence that causes a percolation of other issues into the economy. What do I mean by that? What I mean by that is once, let's say if your unemployment rate was 0.6% above the floor, so 6.0 went up to 6.6%, there's a huge aggregate of spending that's been cut off by every marginal person that's not out there in the economy, interacting with different touch points, spending money, and this causes a self-fulfilling prophecy that starts the gates for a recession and a stock market crash. The way things are going, the way that there's policy both by the Fed and also politically, we don't see a likelihood tangibly of that happening. This is more so a blip. There is a little bit of a short-term play. Now, one more time I want to talk about the potential long-term plays. This is not a classic technical dip that I'm going to talk about in a moment, but this is just a little dip that is good if you want to spend a little bit of money, buy the dip a little bit, or short it a little bit in those specific tech sectors. But in the long term, the real ones that might cause the technical dips or cause the stock market crashes is number one, it's the capital gains tax rate. That once that's finally priced in, the market's going to adjust to that. It's going to cause a little bit of a contraction, but more so the capital gains rate most likely will lump into a package simultaneously with those corporate tax rate increases. Now, don't forget, although it's an accounting issue, it also is something that affects earnings, and especially for some of those larger companies, you're definitely going to see an earnings reduction. So the market needs to price that news in. It's also going to tangibly see that. And although there's lots of companies that are profitable, and this is ultimately an accounting issue, it's not going to affect employment, R&D, and those kind of things, unless it's in that package where you're limited about how much you can write off with R&D and taxes, then the market should create a technical dip there where there's going to be an opportunity to get some good deals 10, 15, 20% below what the rate is. That's that contraction. That's that dip that should happen. But again, that won't cause a recession per se. So the big story here is, listen, this is a minor blip. This won't even cause a dip or a correction. This definitely won't cause a stock market crash. We're nowhere near that. There's nothing fundamentally in the economy right now that's, causing any kind of alarm. So I'll leave it with that. We still got to watch out for all of those other more important factors, capital gains, and also the the corporate tax rate increases as a correction, and some of those bigger players like the Russia sanctions and any kind of updates with the coronavirus or other forms of pandemics, those could also trigger some form of bigger situation economically down the road. So let's pay attention to that. All right, guys, that's all I have on this video. So I'll see you on the next one.